There's a Roth conversion window that closes in 2028, and most people don't even know it exists. That's what we're going to talk about next on Holy Schmidt.
Holy Schmidt!
If you have a traditional IRA or 401k, and most people watching this video do, part of that money isn't yours. It never was. The IRS has a claim on every pre-tax dollar sitting in that account, and they're going to collect it one way or another. The only question is whether you get to decide when and how much, or whether they decide it for you. Right now, there's a 4-year window, 2025 through 2028, where a temporary age 65 plus tax deduction created in the 2025 tax law changes makes the cost of moving money from a traditional IRA into a tax-free Roth account lower than it once was before that deduction. But that deduction disappears in 2028, and most retirees have no idea it exists. Or if they do, they don't understand how it ties into a Roth conversion. But the two are linked in a way that's very important. In this video, I walk you through exactly what that window is, why it matters, and what it will cost you if you don't act while you still have the opportunity to do so. All right, let's jump into it. Now, I want to say something at the beginning of this video because I know a lot of people are going to react to the phrase Roth conversion. These people think that Roth conversions are not for them. They're only for wealthy people, people who have maxed out their 401ks for decades. But the fact of the matter is, with the deduction we're talking about, that's not true. If you have $300,000 or more in a traditional IRA or 401k, a Roth conversion strategy is worth examining very closely for your situation. Not because you're wealthy, but because of what's going to happen to you at age 73 or age 75 if you were born in 1960 or later, whether you plan for it or not. Because here's the thing that nobody tells you when you're busy saving. The money in a traditional retirement account isn't a gift. It's a tax deferral. And deferred taxes have a way of compounding just like investments do, except in the wrong direction. Every dollar deferred in your 40s, for example, becomes a much larger tax event in your 70s, whether you need the income or not. The goal of this video isn't to make you feel behind. It's to show you a specific time-limited opportunity to get ahead of a tax problem that most people don't see coming, really until it's already on top of them. Let me begin by making sure we're all starting from the same place, because I want to be precise about what a Roth conversion is and what a Roth conversion is not. A Roth conversion is not a contribution to your Roth account. You're not adding new money. You're taking existing money that's sitting in a traditional IRA or 401k, money that's never been taxed, and moving it into a Roth IRA. And when you do this, that money and its growth will never be taxable again. In the year that you make that move, the amount converted is added to your taxable income, and you pay ordinary income tax on that. That sounds like a bad deal on the surface. Now, why would anybody pay taxes now if you could defer them? The answer is that the deferral is only an advantage if the tax rate you pay later is lower than the rate you would pay today, for most retirees anyway. But the reality is, for most retirees, the opposite is actually true. The rate that they'll pay later, driven by required minimum distributions, Social Security taxation, and Medicare surcharges, is actually higher than the rate that they could pay right now in the early years of retirement. The Roth also has another major advantage that most people overlook: no required minimum distributions during your lifetime. That means a Roth can keep growing tax-free as long as you live, and you can pass it on to your heirs without forcing them to pay ordinary income tax on the inherited distributions in the way a traditional IRA has them pay income tax. So the question is never whether a Roth is better or worse, in the abstract anyway. The question is, at what rate am I going to be converting now versus at what rate will I be required to convert later, whether voluntarily because I need the funds or involuntarily because of an RMD. The math is what drives the strategy. And here is the part that most people are completely missing, and I want to get really specific because this is the core of the video. The One Big Beautiful Bill Act, signed into law on July 4th, 2025, created a new temporary age 65 plus deduction specifically for Americans age 65 and older. It's $6,000 per person, or $12,000 for a married couple when both spouses are 65 and older. It stacks on top of the current age 65 plus deduction the current standard deduction, and it's in place until 2028 through tax year 2028, unless Congress acts to extend it beyond that point. Let me show you how this works for the tax year 2025 for a married couple, both partners 65 years or older. Layer 1 is the base standard deduction, $31,500. Layer 2 is the age 65 additional deduction, which is $1,600 per spouse, so $3,200 total. And then layer 3 is the new one big beautiful bill, age 65 plus tax deduction, $6,000 per person or $12,000 for the couple. Stack all three layers together and you get a total deduction of $46,700. What that $46,700 means in practical terms is this. A married couple over 65 with $46,700 of gross income that's fully offset by those stacked deductions would have zero taxable income and zero federal taxes due. If that couple had very little other income in retirement, maybe they hadn't started claiming Social Security yet, or they were young enough so that their RMDs had not started yet, they could potentially convert $46,700 worth of traditional IRA or 401k savings into a Roth IRA, tax-free. And even if they had some income, they might be able to convert $20,000, $30,000, $40,000 or more at a low tax bracket, 10 or 12%, let's say. After 2028, that $12,000 age 65 plus deduction disappears and taxable income for the same couple jumps back up by $12,000. The conversion that would cost them little or nothing in 2027 costs them real money in 2029. That's the window and that's what's closing, but there's one important caveat on the age 65 plus deduction. It begins to phase out when the couple exceeds $150,000 in modified adjusted gross income. If you're single, the level is $75,000. If your income's above these thresholds, the full deduction might not be available to you, but even in a partial deduction year, that still might be worth it when you stack everything else on top of these deductions or partial deductions. Now let me explain the tax problem that the Roth conversion is designed to solve, because you need to know what's waiting for you on the other side of that window if you don't do anything. Required minimum distributions are the IRS's way of making sure that your tax-deferred accounts don't stay tax-deferred forever. So starting at age 73 or 75, if you were born in 1960 or later, you're required to withdraw from your IRA or your 401k, regardless if you need the funds or not. The amount's calculated by dividing your prior year-end account balance by a life expectancy factor provided by the IRS for your specific age. At age 73, for example, that factor is 26.5, so a $1 million IRA generates a required minimum distribution of roughly $37,700 in that first year alone. But that's not a one-time event. Every year, the balance divides by a smaller factor, which produces a larger distribution. By your late 70s and early 80s, that distribution can be significantly larger. Now, here's where things get really expensive. Those RMD distributions are added to your ordinary income. Stack them on top of Social Security, and you can quickly push into a bracket where 85% of your Social Security payment becomes taxable. For some people, there's no tax on Social Security, but the more you earn, the more likely it is you're going to pay tax on your Social Security payment. If you stack them on top of capital gains or other income, you can trigger IRMAA, the income-related monthly adjustment amount, which adds a surcharge to your Medicare Part B premium and your Medicare Part D premium. And the cruel irony of this is that you built that account and you invested heavily in that account to give yourself financial freedom and security in retirement, but the required minimum distribution takes some of that away, in many cases anyway. A Roth conversion strategy is specifically designed to prevent this. Roth conversions during the gap between when you retire and when you reach age 73 or 75 are the big years for the Roth conversion strategy, and that's when this is most effective for a lot of people. Every dollar you move into a Roth now is a dollar that will never produce a taxable RMD. The account still grows, but it grows tax-free. And the ideal time, if there is an ideal time, are the years between when you retire, when your earned income drops to zero, and when your RMDs and full Social Security income are impacting your income tax. For most people, this gap is somewhere between 5 and 10 years. During the gap years, your taxable income is at a point that's typically the lowest point it will be for the rest of your life. You're no longer earning a salary. You may not have claimed Social Security, and RMDs haven't started yet. You might have some investment income, some pension income, or maybe some part-time income, but that's about it. That low income period is your conversion runway, and it's the window where you can move money from a traditional IRA into a Roth and pay the least amount of taxes on it. The age 65 plus deduction amplifies the benefits of this runway significantly, as we covered. It effectively widens the tax-free corridor by $12,000 for a married couple over age 65. That means that you can convert more before you reach that first taxable dollar, and that corridor is only in place through the end of 2028, which means that for most pre-retirees and early retirees watching this video, the window is open right now. The question is whether you're using it. One critical timing factor to keep in mind, the IRMAA 2-year look back. Medicare uses your income from 2 years ago to determine whether you pay an IRMAA surcharge on your Part B and Part D premiums. So if you convert a large amount in 2025, that income shows up in your 2027 Medicare premiums, for example. That doesn't mean you shouldn't do it, but it means you need to model the full picture before deciding how much to convert in any given year. Hitting an IRMAA bracket by converting $5,000 too much in 1 year is really expensive. It's not incrementally expensive, it's really expensive. Before we get into a step-by-step discussion, I want to tell you about a tool that I recommend for running the numbers, because the math that I just described, conversion amounts, bracket thresholds, lookbacks, RMD projections, is exactly the kind of multi-variable modeling that's very, very hard to do on a spreadsheet and very easy to get wrong. That's why on this channel we partner with Bolden. Bolden is a retirement planning software built specifically for people navigating this kind of decision. It shows you Roth conversion scenarios, models projected RMDs by year, maps out your tax bracket by year, and lets you stress test different conversion strategies side by side so you can see the lifetime impact. If you'd like to try the full-featured software free for 2 weeks, you can use our affiliate link. You just go to go.bolden.com/Schmidt, and you can try free for 2 weeks. After that, it's $12 a month paid annually if you decide to keep it. So what do you actually do with this information? Well, here are 5 concrete steps. Step 1 is know your RMD starting age and count backwards. If you were born in 1960 or later, they begin at age 75. Count backward from that age to today, and the years in between now and your RMD start date are your conversion runway years. If you retire at age 63 and RMDs begin at age 73, well, you have a 10-year runway. But if you only have 3 years left, your runway is smaller, of course, but it also means that the amount that you can convert is less. It may still be worth it. In fact, in many cases, it very much will be worth it, but you need to do the math. The next step is identifying your current effective tax rate in retirement. Add up your current taxable income, pensions, part-time work, Social Security, investment income, and subtract your deductions. What's left over is your taxable income. If you're in the 10 to 12% tax bracket now and your RMDs will push you into the 22% tax bracket, well, you have a clear conversion opportunity. The wider that spread, the stronger the case for converting. Step 3, calculate how much you can convert each year without triggering unintended consequences. This is the single most important step, and there are 3 ceilings to watch. First, the top of your current tax bracket. You don't want to convert so much that you jump into the next one unless the math still works. The second is your Social Security thresholds. Combined income above $32,000 for married filers starts your benefits becoming taxable, and above $44,000, up to 85% of your benefits become taxable, as an example. Third are your IRMAA surcharges. In 2026, if you had taxable income above $109,000 in 2024, or $218,000 if you're married filing jointly, you've reached the first Medicare surcharge, and it only goes up from there. Step 4, pay the conversion tax from non-IRA funds. If you use IRA money to pay the tax on a Roth conversion, you're reducing the amount that goes into the Roth. The tax on this conversion should come from a taxable brokerage account or from cash savings. This is also why having liquid assets outside of your 401k and IRA is really important. Step 5, model it before you do it. A Roth conversion strategy is not a one-time decision. It's an annual process. Your income changes, your account balances change, tax laws change, IRMAA thresholds change. What makes sense in 2025 may be different in 2026 or 2027, so run the numbers each year. The goal is to fill your lowest available brackets with converted income each year through the window, then stop when the window closes or your traditional IRA has become right-sized. Gang, here's the bottom line. The OBBBA created a 4-year window, 2025, 2026, 2027, and 2028, where a temporary age 65 plus deduction of $6,000 per person widens the tax-free corridor for Roth conversions. Most retirees are sitting on a large traditional IRA balance and not doing anything with that balance, not even thinking about it, to be completely candid. It's not because of a deliberate choice, they just don't know that the opportunity exists. And this is the most expensive kind of mistake, usually anyway. The one made by default, not made by decision, and frankly, you don't need to convert everything. You don't even need to convert aggressively. Even converting a modest amount each year, staying inside of your current bracket, staying below the IRMAA thresholds can have a meaningful impact on your spendable income later on in life. If you like this video, check out that video, how a couple pays 0 taxes on their first $100,000 of income. Also, don't forget to check out Bolden. Just go to go.bolden.com/Schmidt. Get your 2 weeks free. After that, it's $14 per month if you decide to keep it. This is Jeff Schmidt, and I will see you in that video right there.